Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings before they make no sense of your investments. Today, we're diving into a Form 8K from LiveRamp Holdings, and trust me, it's not as boring as it sounds. We're going to uncover a story of restructuring, financial adjustments, and a bit of corporate soul-searching. It's like a business makeover, but with spreadsheets. So March 6th was a busy day for LiveRamp. This report is basically a snapshot of some pretty big changes happening inside the company. First up, something nobody likes to hear, a workforce restructuring. In simpler terms, they're cutting some jobs. About 65 full-time employees are affected, which is about 5% of their workforce. Now, companies don't just lay people off for fun, usually. LiveRamp says this is part of a plan to become stronger and more profitable. They want to focus better, make things simpler, and run their business more efficiently. It's like decluttering your house, but with employees. Of course, all this costs money. LiveRamp estimates they'll spend about $6.5 million on these changes. Most of that is going to be for things like severance pay and benefits for the people who are leaving. And they expect this to mostly happen within the next few weeks. It's important to remember that these kinds of changes can impact a company's financials quite a bit. Because of these changes, LiveRamp is also updating its financial predictions. They're changing their expected operating income, which is basically the money they make from their main business before things like taxes and interest are taken out. The company now expects a GAAP operating loss between $13 million and an income of $5 million for the current period. This change is because of the $6.5 million they're spending on the restructuring, but there's also a small decrease in stock-based compensation, which helps a little. To clarify GAAP operating loss, GAAP means Generally Accepted Accounting Principles. These are a standard set of rules that all companies use to record and report their financial info. Here's some good news. LiveRamp is sticking with its earlier predictions for revenue and what's called non-GAAP operating income. Non-GAAP means not following those standard accounting rules exactly. Companies often use non-GAAP numbers to show what they think is a clearer picture of their performance, leaving out some unusual or one-time expenses. These earlier predictions were shared last month when they announced how they did in the previous 3 months. If you're wondering about the difference between those GAAP and non-GAAP numbers, LiveRamp included a breakdown in their report. It shows exactly how they get from one to the other. So you can see a reconciliation of GAAP to non-GAAP operating income for the fourth quarter and fiscal year ending in March. And speaking of things to look at, all these details and numbers are included as exhibits, so you can dig in if you really want to get into the weeds. Now for the part everyone loves, legal disclaimers. LiveRamp reminds us that they're making forward-looking statements. These are basically guesses about the future, and they come with a big warning label. The company says that there are many things that could make their actual results different from what they're predicting. These include everything from the economy to competition to technology changes. It's like saying, we're trying our best to see the future, but who knows what's really going to happen. They also go into specifics. They talk about things like interest rates, the risk of a recession, and even geopolitical issues like wars. These are all big things that could mess with their plans. They also mention the usual business worries like keeping customers happy, dealing with competitors, and keeping up with new technology. LiveRamp also points out the challenges of growing through acquisitions, like the acquisition of Habu. Sometimes, it's hard to make these new businesses work well together. And of course, they need to keep attracting and keeping talented people. This workforce restructuring itself could be a problem. It might not go as smoothly as they hope. And doing business in other countries comes with its own set of risks, too. Cybersecurity is a big worry, too. A data breach could be a disaster for their business and reputation, and they might not have enough insurance to cover all the costs if something bad happens. There's also a risk that their clients might not be able to use their data platform as easily if the rules around online tracking change. This is a big deal in the advertising world. And finally, LiveRamp reminds us that the legal and regulatory landscape is always changing. This can create new challenges for their business. Basically, there are a lot of things that could go wrong. Now let's zoom out and think about what all this means. LiveRamp is going through a tough but common situation, trying to become more efficient in a changing world. The job cuts are never good news, but the company seems to be trying to focus on what it does best. One of their strengths is that they're working in a growing field and they have a lot of expertise, but they also face some big challenges. The economy is uncertain and there's a lot of competition. Plus, they have to deal with changing rules about data privacy. One thing that stands out is that all the risks the company mentions are basically standard risks for a company of that size. Nothing out of the ordinary, which can be seen as a positive. Overall, LiveRamp seems to be taking steps to stay competitive. They're cutting costs, focusing on their core business, and trying to adapt to a changing world. It's not going to be easy, but they seem to have a plan. Thanks for watching. If you found this decoder helpful, please hit that like button, drop a comment, and subscribe for more corporate insights. Until next time, keep your eyes on those filings.